This afternoon, we are going to discuss one of the most highly debated and misunderstood topics in investment management, the value that active and passive management play in delivering desired outcomes for investors. As you heard this morning, the IAA has formed an Active Managers Council that is engaged in providing education and thought leadership regarding active management. We believe that the binary passive versus active narrative is a false dichotomy. In fact, both active and passive management have important roles to play in investment management and in our markets. And investors and their advisors should be free to choose the approach that best suits their goals and needs. The speakers you will hear this afternoon will offer their expert perspectives on this issue in a series of TED-like presentations, followed by a moderated discussion. And here to lead the discussion is the Managing Director of Research and Innovation at FTSE Russell, Rolf Agatha. Rolf leads a global team in the creation of new index concepts and research on indexation, investment management, and the capital markets. Please welcome Rolf Agatha.
I want to thank everybody for sticking it out to the last session of the day. As Karen said, my name is Rolf Agatha. I manage the research team at FTSE Russell. We are an index provider. The research team at FTSE Russell, we're the ones that develop all these great new indexes that become the basis of all these great passive products. And increasingly, we spend a lot of time doing client education and client engagement. As Karen mentioned, we're going to have the panel's going to get up and give presentations. And so I thought, one of the first things I would do is try to set some context, maybe answer two key questions as a way of setting the context for what we're going to talk about today. The first question I'm going to address is, what's an index provider doing on a panel talking about the advantages of active management? And I always want to be, I want FTSE Russell to be seen as one of the index providers who does believe that there is value to active management. There's clearly an economic self-interest here. So as much as we benefit from all the assets that flow to passive products, a big part of our business is selling data and analytics to active managers. So, just from a mission perspective, our goal is to help all investors, make better decisions and have a broad range of tools that they can choose from. So, there's that self-interest just economically. A big client base of ours is active managers, as well as just the mission that we have of improving decision-making for investors. So we really don't see, active, passive, at least from an index provider perspective, as this adversarial relationship. And so hopefully, as we have the discussion and we moderate some of the questions, I can contribute to that. So the second question, I think, for you in the audience is, what's the relevance of this to you as a decision maker? And I think there's really two dimensions to that. So obviously, for those of you that are involved in the investment decision-making process, there is a lot of information in the marketplace, or conventional wisdom, I think, as we'll discuss, about active management and whether or not it actually adds value. And so I think it's important that as investment decision makers, you're able to have a complete set of information and recognize that what might be seen as conventional wisdom may not necessarily be true. So we actually have the benefit of having a number of different perspectives on the panel. You'll be able to see, some of the academic evidence for the realities of active management. You'll be able to see from an institutional asset owner how they view active versus passive, and then even from the asset management or product provider side. So I think as investment decision makers, it's important. But also as potential business owners, right? I think you have to deal with clients who are obviously reading the newspapers and seeing some of the headlines that come out. And so I think it's important, that you're armed with some of the messaging. Should you get, questions about, well, I hear active management doesn't work or it's too expensive. I think, hopefully some of the discussion today will be useful in just arming you with some of the key messages maybe that you can communicate within your firm and to your clients. We won't really touch on it today, I don't think, but it's also interesting, right now there's also a related set of discussions going on with respect to the passive industry in general and whether or not it's becoming too big. So even though today's topic is really dealing with active and passive within the investment industry, recognize that as the amount of assets flowing to passive investments has grown, there is increasing concern among potentially regulators about whether we are now, increasing the systemic risk within the marketplace. So, again, it's a very related discussion. I also speak on panels, just talking about, the amount of passive management that's out there, And obviously, you know, I don't think there is. Again, I think there needs to be a healthy balance between active and passive management, and I don't think we've gone beyond that. But clearly, there is concern among the public and potentially of the regulators about just the amount of assets now that are being managed passively. So with that as a context, I'm going to go ahead and just provide introductions of all 4 panelists. So what will happen is they'll each get up here and they'll give a presentation. They've each got 12 minutes. They'll do that in succession. After the panelists have spoken, the music will come up and we're basically going to have the Q&A discussion. So there'll be a few minutes while we get the chairs back on stage. So after the last presentations, please don't get up and leave. We then want to have a panel discussion. And also we seem to have a bit of time here. So I'm hoping that, you know, this is your chance to really ask questions of the experts in the field. Again, if you have questions that might help you either run your business better or make better investment decisions, now's the time to have those questions available. And we'll have, I think, 2 people in the room with microphones to give you a chance to do that. So with that, I'll start to introduce the speakers. The first one is going to be Professor Martin Kramers. He's the Bernard J. Hank Professor of Finance at the Mendoza College of Business of the University of Notre Dame, where he's been a faculty since 2012. Prior to that, he was a faculty at the Yale School of Management for 10 years from 2002 to 2012. He obtained his PhD in finance from the Stern School of Business at New York University in 2002 and hails from the Netherlands. Starting in July of this year, Professor Kramers serves as the interim dean of the Mendoza College of Business. David Lafferty is the Senior Vice President and Chief Market Strategist at Natixis Investment Advisors. He is responsible for assessing economic and capital market trends and their implications for investment portfolios. Scott Gonsolin is an investment manager on the public markets team at the Teachers Retirement System of Texas. It's a $152 billion pension system serving 1.6 million active and retired educators and their families. Scott supports the Trust's $40 billion portfolio of externally managed public market assets with coverage on both hedge funds and long-only mandates. And then our 4th speaker, Ann Lester, is a portfolio manager and head of retirement solutions for JP Morgan Asset Management Solutions, where she's responsible for advancing the firm's market-leading retirement investment product offering and thought leadership. Ann is a seasoned asset allocation specialist who has been responsible for the development of the firm's defined contribution asset allocation strategies, including the JP Morgan Smart Retirement Target Date Funds and the firm's dynamic withdrawal strategy. So again, 4 speakers, each with their own unique perspectives, and I'd like to go ahead and start by inviting Professor Kramers up to the stage. Thank you.
So thank you. And thank you all for coming, and I'd like to thank the organizers for this opportunity to share our research with you. The paper I will discuss with you was actually sponsored by the IAA. I'm also particularly grateful for that. The title of the paper is Challenging the Conventional Wisdom on Active Management. And so what I'm going to do in the 12 minutes I have is first describe this conventional wisdom, and then go through the 3 points of this conventional wisdom one by one, and share with you what our conclusions are after reading over 300 different academic papers published over the last 20 years. So the 3 of us, this is joint work with John Fulkerson from the University of Dayton and Tim Riley from Arkansas. The 3 of us read collectively over 300 papers so that you do not have to. So we have a new survey of these over 300 different papers, and we had a kind of an impossible task to summarize that in 20 pages. And now as a professor, I have to try to summarize this to you in 12 minutes. Well, normally as a professor, I generally give talks of 90 minutes, so bear with me. What we did is we started with one of the most seminal papers in the literature on active management, which is Mark Carhart's 1997 paper. And his conclusions for us are the starting point for the conventional wisdom. And then we look at the 3 main points that he made. Our goal of our paper is to evaluate what is still true. To what extent does that conventional wisdom from 1997 still hold? Because a lot, of course, has happened in the last 20 years. So in our paper, we go into some of the things that have happened. Right? Many, many changes in the investment management industry, its size, its complexity. And so we go a bit in detail there, which I don't have time for today. Our point is to look for support for or against the conventional wisdom. our conclusion is that the recent academic literature really challenges this conventional wisdom. That in general, we think the academic literature in the last 20 years has become much more positive about active management than the academic literature as of 1997. So here's the conventional wisdom. So Mark Carhart's 1997 paper, he concluded that in 1997, using his methodology and his data, that data did not support the existence of skilled or informed mutual fund portfolio managers. He wrote this paper in a fairly strong language and somewhat unconditional. So now it depends, not too much hedging. Okay? This is a seminal article with over 13,000 different citations. So for an academic finance paper, this is in the stratosphere. Okay? So this is a very seminal paper, which we argue, together with other papers, many of which we cite in our study, has created this conventional wisdom. That's three parts. First, the average fund underperforms after taking into account all costs. Second, yes, some funds outperform, but that outperformance does not persist. So the funds that end up outperforming are different every year, and so it's very difficult to predict which funds are going to end up outperforming in the future. Third, yes, some managers are skilled, but the skilled managers generally are more expensive. So after costs, right, the end investors do not benefit from that skill. Next, I'm going to go through these three conclusions and see what the academic literature in the last 20 years has to say about this. First, the average fund underperforms. The support for this is largely the sharp argument about the arithmetic of active management, thinking about active management as a zero-sum game. This is also driven by a certain static perspective on investing and the market portfolio being the same for everyone and not changing over time. At the same time, there's a lot of empirical support for this. A lot of papers actually do show, even in the last 20 years, that on average, actively managed mutual funds do not strongly outperform over the long term. So this is the one conclusion where we say there's actually strong evidence for the average fund. Second, the performance of the best funds does not persist. The main support is the Carhart paper. Then third, some fund managers are skilled, but few have skill in excess of costs. There are various papers before 97 that document this. A very prominent, more recent paper is by Farmer and French in 2010, where they also find this. As a result of this conventional wisdom, we've seen major changes, we think, in the market. A major shift away from actively managed to passive. So in 97, which we take as our starting point of our survey, about 8% of assets in the US mutual fund world was invested in passive products. At the end of our survey, 2017, that's about 40%. There's some literature that challenges this notion that the average fund underperforms. Most of these papers challenging this make a methodological point. Is that the methodology that is used in these studies to conclude this make a bunch of assumptions or use a certain methodology that biases you against finding outperformance. Okay? This is a somewhat technical discussion. We give some of the details in our paper, and I don't have time for those details right now. But the methodology really matters. Data really matters. Time periods really matter. If you relax some of these assumptions, if you look at more sophisticated statistical techniques, if you look more about what's actually accessible in terms of benchmark performance, in terms of tradable portfolios, what are you comparing actively managed portfolios with? You become a lot less confident that the average fund underperforms. Second, there's no performance persistence of the very best funds. This is a result that I think has been clearly been challenged by the more recent literature. There's a bunch of papers that find strong evidence for performance persistence challenging Mark Carhart. Some of that is taking into account, again, of better methodology, better data, also higher frequency data. And a good example is the Bollen and Bussey paper 2005, that the 10 to 20% of top performers, they seem to have really the ability to perform more persistently over time. Then 3, some fund managers have skills, but few have skill after taking into account all costs. Here, there are many papers that also challenge this. One of those is by myself with Ante Peter-Justo in 2009, where we introduced a measure of active share, which is a basic statistical tool that compares the holdings of a fund to the holdings of the fund's benchmark. The point that we make is that many funds that say that they're very active may not be that different from their benchmark. So they don't have a high active share. Among the high active share funds, there's actually strong evidence, we argue, that there's no underperformance, perhaps even outperformance. Among the low active share funds that are not cheap, there's very strong evidence that investors do not benefit after costs. So even though this may be to some extent true on average, there's various ways in which you ex ante can identify funds that have a much better chance on average to outperform or underperform. In our paper, we give other examples other than active share of how to distinguish among funds. So how do active managers then create value? There's some obvious ways, by selecting stocks that outperform, or very importantly too, by timing the market. There's a whole bunch of papers that show that actively managed funds tend to do better in down markets or during recessions. Less obvious ways are through voting or by text, by creating portfolios that are very tax efficient. The conventional wisdom also has other limitations. Most of the research that gives rise to the conventional wisdom is based on research only looking at US equity mutual funds. Now, arguably, that may be the least persuasive market to consider the power of active management, because the US equity markets are dominated by large caps that are arguably in a very efficient, very competitive market. Once you go outside US large caps, you go to small caps, you go to bond funds, you go to hybrid funds, international funds, emerging markets, hedge funds. Arguably, those environments may be more promising, maybe better opportunities for active management. And there's significant literature that suggests this. At the same time, the limit is that there's simply not that many papers because most papers, again, focus on US equities. There are also real research obstacles in evaluating. One is that academics, we disagree a lot. And we haven't been able to have a consensus model for performance evaluation. So many different papers will do their own thing. And I'm one of those people who also disagrees with the standard method. I think the Farmer-French model, the way they do performance evaluation, I have a lot of issues with. But at the same time, because there's so many different ways of evaluating performance, and there's really no consensus among academics how to do this, this makes drawing conclusions as academics very, very difficult. I also want to acknowledge that as an academic, it's very difficult for me to understand the process that gives rise to actively managed portfolios. The whole investment process that leads to whatever we're studying and how much we see of that is very limited. There's many things that managers are doing or ways in which they may contribute value to their clients that we simply don't see. So we need much more data. We need a much better understanding. In our paper, we give some directions to academics of other things to study that we haven't even started to study. So to conclude, we find over the last 20 years of over 300 academic papers, and I think we end up citing close to 300 published papers, that active managers have a variety of skills, and we find a lot of evidence that they create value for their clients, that after cost, many of them actually do generate positive value for investors, and therefore that active management is much more promising than if you believe the conventional wisdom.
Thanks, Martin. Next, welcome to the stage, David Lafferty, Chief Market Strategist for Natixis Advisors.
Well, welcome everyone. Martin and I did not talk about what we were going to do ahead of time, but I think you will see that my slides dovetail very well with a lot of the concepts that he's talking about. He talked about challenging the conventional wisdom. I'm going to address what I call three big underlying misconceptions of active and passive. My marketing department says it's better to call them myths. It sounds sexier, but I call them misconceptions. And in many ways, they will get at some details behind what Professor Kramers was talking about. So one, I'm going to talk about whether markets are efficient or not, and I don't think that's really the issue. The second is that indexing is killing active management, and I'm going to make the argument that very much the opposite might be true. And then I'm going to talk a little bit about whenever you get in an argument with someone who is a zealot on passive, they pull out this knockout punch that Professor Kramers has already referenced on the arithmetic of active management, and I'm going to address how we feel about that. So first of all, markets are too efficient. I doubt that market efficiency is a huge driver of what's going on here. In the long run, that might be true. We could look at lots of asset classes, and maybe in certain asset classes, the average manager is 50th percentile or 55th or 45th. But what it doesn't explain is the outliers, those periods of time when the S&P 500 is way up in the rankings or way down in the rankings. In 1999, the S&P 500 beat 80% of the large cap blend managers. In 2000, 80% of the active managers beat the S&P 500. So I doubt that the market was massively efficient in 1999, massively inefficient in 2000. I also don't think it's largely about manager skill for the same reason. It's unlikely that all these managers were idiots in 1999 and they became geniuses in 2000. So what do I think is really going on when we see active managers fall and rise in the rankings significantly? It's probably not driven by efficiency or manager skill. It's driven, in my mind, by these active performance factors. And somehow my not equal sign ended up in the wrong place. But the sum of all the active managers does not, in my mind, equal the index. That's the heart and soul of the Sharpe paper that I'll reference in a minute, and what Professor Kramers mentioned. It's important that people understand there are systematic differences between a universe of active managers, the index that they run against. And these differences, in my view, largely explain the fortune or the misfortune of many of these active managers from period to period. What are some of these factors that we've looked into? The first one is market direction. There's empirical evidence that you could argue either way on some of these, but again, ceteris paribus, other things being equal, you should understand basically the direction of the effect. Market direction is the first one. The vast majority of actively managed portfolios hold cash. Market cap weighted indexes do not. Other things being equal, dramatically rising markets and indexes is not a good environment for active management. Similarly, when the market falls out of bed, it won't always be the case that active managers outperform or all active managers will outperform, but other things being equal, bear markets should help. Again, managers tend to hold cash that the indexes don't. Cap skew is important. The vast majority of managers, particularly in large cap space, do not run portfolios as big as the indexes. I looked at this a couple of weeks ago. According to Morningstar data, 80% of the managers in the large cap blend universe have smaller market cap characteristics than the S&P 500. So when mega cap stocks run, that's generally bad for active managers. And when the smallest cap stocks, I don't mean small caps, I mean smaller, the other 450 in the S&P, that's usually good for active management. Reason behind that is the vast majority of managers are not overweight mega cap stocks. You would eat up your entire portfolio if you tried to be 3 or 4% overweight the 25 biggest stocks in the index. You'd only be able to run about a 30 stock portfolio. Benchmark density is important. What I mean by that is how the cap looks. The S&P 500 is a fairly dense benchmark. It has lots of names with big weights and then a few that have small weights versus, say, the Russell 2000 where you have 2,000 stocks that all have really low weights. It turns out that the less dense the capitalization range in the benchmark is, the easier it should be to beat the benchmark. This has to do with active share that we'll talk about in a minute, but I always hear small cap managers say, well, I have over 90% active share. It would be almost impossible for a small cap manager to have less than 90% active share. The largest holding in the Russell 2000 is about 35 basis points. Largest holding in the S&P 500, Apple, is 4.5 basis points. So it's much harder to beat the S&P 500 than it is to beat the Russell 2000. And then in bond space, Professor Kramer said this, we look a lot at US equities, we don't look at other asset classes, but in bonds it's basically about credit. Most fixed income managers are overweight credit, we own lots of yield, and when we out-yield the benchmarks and credit does well, we do well. When credit falls out of bed, active managers do poorly. I don't think they're geniuses one day and idiots the next day. So during periods where active managers, when active management is either really in favor or out of favor, I really think it's about the math of the underlying portfolios, not the magic of market efficiency that you often hear about. Indexing is killing active management. They use this little thermometer chart. Why is it killing us? Because the vast majority of a lot of these asset classes, we can't get up to 50% of the managers beating the index. How do we get up there? I would argue that the competitive stresses of the success of active management is starting to, passive management, make the active managers better. You've all heard the misquote of Charles Darwin, close to what he said, but not actually what he said, that it's not the strongest that survived, that the most adaptable. And I actually think that adaptability is what passive is bringing to the active world. I call this portfolio Darwinism. It's the idea that the competitive pressures of passive indexing is making active more competitive. If you want to see, I'll talk about this in 2 minutes in a second, but if you just want to Google this, I wrote an op-ed that got printed in 5 or 6 journals, periodicals around the world. You can just Google how passive indexing will save active management, and you'll get 1,200 words on this subject. In more like 100 words, 5 things driving this Darwinism. Fee compression. Chip Rome was almost right this morning. He said that the average fee is not coming down. The average fee is coming down. It's just not coming down very much. It's come down over the last 10 years by about 4 or 5 basis points. So think of a large cap growth manager that used to charge 80 is now charging 75 or 76. But what he was right about is the asset weighted fee is coming down dramatically. Okay? The money is pouring out of high cost share classes and into low cost share classes. And a lot of those low cost share classes are going to disappear and will no longer be structural underperformers left in the benchmark for that comparison. So again, moving up that thermometer should be good. The waning use of soft dollars, whole bunch of other things are driving fee compression. And remember that indexes are bounded theoretically by the zero bound on fees. Fidelity just launched 2 funds that have a 0 fee to them. Active managers can continue to reduce their fees. Most of the major market cap indexes are pretty much done with that. Ruthless pursuit of alpha, machine learning, smart data, data scraping, liquidity management, acquisition of cash. Portfolios are becoming more efficient. The death of closet indexers. Professor Kramers has written the seminal paper on active share. Basically, high active share is winning the day. If you have lots of overlap with the benchmark, by definition, that capital can't beat the benchmark. Couple of things that indexing doesn't give you, which helps active management, is potentially greater mispricings, greater opportunity. I am nominally the chair of the research committee of the Active Managers Council. This is one of the tracks that we're attacking, is this idea of market, whether it's efficiency or new opportunities be creating because markets are becoming less efficient. It isn't clear to me that investors are willing to just buy what's in the benchmark at the benchmark weight without any forethought of valuation, fundamentals, or corporate governance. And lastly, it isn't necessarily that active managers will outperform the down market, but I think investors will want that optionality. Know that the indexes can't outperform the market because by definition they are. My final takeaway on this is that indexing is not going to kill active management, but very likely may kill bad active management. Managers that charge too much, don't have enough active share, turn their portfolio over too much. Active management is not going away. Bad active management is probably going bye-bye. I won't cover this for the sake of time. I'll simply quickly say all of those 5 variables that I mentioned, at least 4 of them require good security selection. Only lowering your fee alone in the absence of security selection will actually improve the performance of active managers. Going down the list, the ruthless pursuit of alpha. If you're not finding the stocks through this ruthless pursuit, it's not going to help. High active share. If you pick the wrong stocks, high active share doesn't help you. If markets become inefficient, but you're not in the inefficiently priced ones, it won't help. And if the market goes down, but you're not prepared for that, you're not going to outperform. So at least 4 of these 5 factors still require good security selection, which means manager selection matters. I just went back instead of forward. The final passives knockout punch. Martin mentioned this, the 1991 paper from Bill Sharp. If you haven't read it, you don't have to. You've all heard it in one form or another. Take all the active managers and all the passive managers, throw them together. You get the market. By definition, the average active manager has to have the return equal to the market before fees. Once you add fees, the average manager has to, by definition, underperform. First of all, I would argue there's not a ton of empirical evidence to support that. When you look at long periods of time, we find lots of asset classes where the average manager had their underperformance or outperformance doesn't look anything like the benchmark net of fees. In some, the average manager dramatically performs the benchmark, and some they dramatically underperform. This is the only one of the only research studies I've ever read where in the introduction they basically see they say we don't need any empirical evidence because the logic is so flawless. That scares me a little bit. But I would say even if this were true, and I'm not convinced it is, but I'm willing to grant it for this one afternoon, are advisors and investors really seeking the returns of the average active manager? This logic assumes there's no way to pick good active managers. Professor Kramer's research study that he just showed summarized that there are ways to do it if you focus on certain factors. So how do we take managers who aren't making and get them up index or above the index? What percent of these managers can really outperform? Well, let's do a few things. Let's eliminate all the structurally overpriced funds. Let's eliminate all the funds that don't have enough portfolio flexibility or high enough active share to outperform. And let's eliminate all the funds that have really high turnover. Another factor that Professor Kramer's has highlighted in his research. Then what does the world look like? Do you still have less than a 50% probability? Well, I took the hardest asset class I could find to beat the benchmark, Morningstar's US large cap blend, and did a very back of the envelope calculation. There's all kinds of look back bias in this. There's some survivorship bias, very back of the envelope, take it for what it is. The last 10 years, I use median statistics because not all the statistics are available for all the funds for the whole time period. But I did a simple sort. There are 563 funds, 94% of them outperformed. That was 17% roughly. I then eliminated all the funds that didn't have 80% active share. I eliminated all the funds that were above average expenses, which the average was 109 basis points. And I eliminated all the funds that had greater than 50% turnover. That got rid of 93% of the funds, and now 16 outperform 39%. I didn't get up to 50. I picked a really hard asset class, but think of it this way. By doing a brain-dead due diligence screening that my 10-year-old daughter could do if she stole my Morningstar password, I just doubled your probability of picking an outperforming manager. I didn't even actually do any real due diligence. This, to me, is winning the loser's game. It's not about finding the world's greatest manager. It's about avoiding structural laggards. If you avoid the structural laggards, you're probably going to find a good manager. I'm out of time. I'll sum it up with my 3 points. If you understand how active portfolios are different on average than the indexes, then you generally know why and when managers do really well or really poorly in a particular period. Point 2 is portfolio Darwinism. I think the competitive pressures of indexing is good for the active management industry. It's going to fix a lot of the problems we've had. And point number 3, investors are not doomed, even if you believe the arithmetic of active management, that the average manager is likely to underperform net of their fees. This does not doom investors to buying bad funds if they focus on the right manager selection characteristics. With that, I'm out of time. Thank you very much for listening.
Thank you, David. Next, welcome to the stage, Scott Gonsolin, Investment Manager, Teacher Retirement System of Texas.
All right, this is the best day of my life. Hey, so my name is Scott Gonsolin. I am with Texas Teachers. We are a $150 billion pension plan down in Austin, representing 1.6 million active and retired teachers. Today, I want to talk a little bit about how our organization is thinking about active management and passive management. Before I do, I want to do a high-level overview of our asset allocation at Texas Teachers. So as you can see on the chart, our trust has about 60% of its assets allocated to global equity. These are assets we would expect to do well during normal, healthy economic environments like public equity, private equity, certain hedge funds. We have about 20% of our assets in what we call stable value. These are assets that should do well in an economic downturn, include things like treasuries, cash, and certain market neutral hedge funds. We've got about 20% in what we call real return. These are strategies that should do well in an inflation surprise, like real assets, tips, commodities. And we have a small allocation to risk parity. So as you can see from the chart, the short answer to the active passive question at Texas Teachers is that we are heavily skewed towards active management. About 80% of our assets are managed actively. And the only material allocations that we have to passively managed strategies are our treasury portfolio and our tips portfolio. And then as you can see in blue, there's a small slug of public equity that's passively managed. But that's really functioning as a placeholder right now. So even though Texas Teachers, clearly from this graph, is very heavily skewed towards active management, over the last 2 years, we've had a little bit of evolution in our thinking around active and passive. And I want to talk a little bit about the beliefs that underlie some of the changes and some of the changes that we've made. So first, belief number one, and this shouldn't be surprising after the presentations that we've heard. At Texas Teachers, we believe active management works, but it works better in some places than others. So these charts, again, not super scientific, kind of probably similar to what David did, take the median 3-year excess return, this is gross of fees, of US large cap managers, and the median 3-year excess return of developed international managers. So for example, as of December 2017, the median US active manager was underperforming its benchmark by about 35 basis points per year, gross of fees, over the last 3 years. Over the same time period, the median international developed manager was outperforming its benchmark by about 100 basis points a year for the last 3 years. As the chart shows, the excess returns of IFA managers over the excess returns of US managers have been pretty consistent through time, particularly since the financial crisis. And in fact, if you were to just pick a random IFA manager from this data set after the financial crisis, you have about a 75% chance of outperforming the benchmark. For the US managers, that's 47%. Again, these are gross of fees. We'll probably explain some of the difference between me and David's numbers. But my team would like to believe that we're a little bit better than picking the random manager. If not, we probably shouldn't have our jobs. But it is helpful to know when the odds are on your side and to know which geographies and which types of strategies might be a little bit more supportive of active management. So that's kind of belief number one. When we examined our own internal results, we found a similar thing to be true. So this shows the 5-year alpha of TRS public equity portfolios. So you've got our external managers, my team, internal fundamental managers, and internal quantitative. And as you can see, managers operating in international developed, which is IFA, and emerging markets, were generating excess returns at or above their target levels. They were doing great. When you look at the US, the external managers, which is my team, and the internal fundamental team, candidly were generating terrible results. So like I said, we not only find this to be true in the broader universe of managers, which is that previous slide, we found this to be true when we looked at our own performance and our own results. I'll show you one more chart at the risk of beating a dead horse, but this is some work that an external partner of ours, Man Group, did. And it essentially finds the same thing is true in hedge funds. And that is that after you adjust for equity beta, the median US hedge fund doesn't generate any alpha, whereas the median European hedge fund is generating about 40 basis points a month. So why is this the case? We don't know. You guys have heard some theories on this up here. My personal belief is that the US market is a little bit more efficient, that you have a lot more people looking at that market, and when you have that much more competition, the average returns go down. But maybe me and David will have a debate on that later. That's a lightly held theory. The point was, for us, we empirically found that active management wasn't working in the US, and even if we didn't know how to explain it, we had to acknowledge that that was the case. All right, so the next belief is that there are risk factors that generate excess returns and that our portfolios should be positively exposed to them. So on the chart, you see 3 risk factors that are pretty widely believed to produce positive excess returns: value, momentum, and quality, also known as defensive. Each of them has a positive Sharpe ratio between 0.5 and 2. Not a bad correlation matrix there. Value is diversifying its momentum. It's uncorrelated to quality and defensive, and quality and momentum have a modest positive correlation. Put them all together and you get a pretty nice looking return profile. Now, can you build a factor portfolio that captures that return exactly? It's very doubtful, but can you be intentional about leaning into these factors and being positively exposed to them so that you benefit from them instead of betting against them and having them detract from your performance? Absolutely. And at Texas Teachers, we're able to do that with our internal quantitative team. And one of the punchlines to this presentation is that the closest thing that you'll find in TRS public equity portfolio to passive management are internally managed, factor-based smart beta strategies that provide us with access to value, momentum, quality, and defensive. This chart just shows that Quant Strategies figured this out a long time ago. It's very rare to find a quant strategy that does not tilt towards one or more of these factors. You can see that in the top heat map, that on average, a lot of these strategies have one or all of these factors. Fundamental active managers are a lot less consistent in this area. That doesn't mean that they can't generate alpha. It just means that if you want to build a portfolio that has positive exposure to these risk factors, you're probably going to have to utilize some quant or smart beta strategies. You're probably going to have to move outside just traditional fundamental active management. At Texas Teachers, we are fortunate enough to have the resources to have an internal quant team. They are not going to probably be able to compete with the biggest, baddest quant firms on Wall Street. But do we believe that they can build a factor portfolio that tilts towards these things? Absolutely. And that's a critical role that they play at Teachers. Okay, so if you believe that active management works better in some places than others, and you believe that there are that there are factors that can generate positive returns, and you have $150 billion to put to work, then what should you do? So the first thing that we did was to stop digging. So my boss, Brad, always says that if you find yourself in a hole, the first thing you need to do is put down the shovel. And for us, that meant that we had to significantly reduce the amount of assets that we had in US-oriented active management. We brought this down by $12 billion, which is about half of the portfolio. And that included completely shutting down our internally managed fundamental US equity portfolio. A lot of that money went to, like I said earlier, our internal quant team that was doing more factor-based investing. And we did retain relationships with our highest conviction external managers, but we do currently have about $4 billion sitting in passive while we kind of formulate our game plan on what to do going forward in the US. So we haven't thrown in the towel on US active management, but we did have to kind of acknowledge the results, acknowledge the data that we saw, and essentially put down the shovel. So that's the first thing that we did. The second thing is stop swimming upstream. And this relates to the factor exposure that we talked about earlier. If historically we only had a risk system that required us to not bet too far against these factors, we now consider these factors to be a very important component of the excess returns that we're trying to produce, and our portfolios are required to maintain positive exposure to them. One of the biggest things that helped us do this was the reorganization of our public equities team. So historically, our internal team and our external team were completely siloed, building portfolios that were completely unaware of each other's factor exposures and capabilities. We subsequently brought all of our public equities under common leadership and a common portfolio construction methodology. And that allowed us to let the quant team focus on building factor-oriented portfolios and achieving this exposure for us. And it allows my team, the external manager team, to be a little more factor agnostic and source active managers who are providing differentiated sources of alpha. Which leads to the last action, which I will call, don't hire a clown to fix a leak in the roof. So if we have the capability of building factor-based portfolios, the last thing that we want to do is hire an external manager who's only building a factor-based portfolio. That would be like hiring a clown to fix a leak. And so my team, like I said, has become a little bit more focused on sourcing differentiated sources of alpha. A classic example of this is a lot of value managers believe that their fundamental research is the main component of their excess returns. And that may be true for some of them, but if you look under the hood for others, you'll find that a simple factor-based strategy might generate the same return as they did. And like I said, those are the types of managers that my external team is looking to avoid, because we don't need to pay people to do that. We can do that internally. So that kind of leads to the logical question of, well, then what is considered a differentiated source of alpha? And there's lots of answers to that question. A couple of examples where we still believe things work. One, traditional stock work does still work. We still do believe in it. We think it is more difficult in efficient markets like the US. We think it works a little bit better in international markets. But there are organizations that have the resources, the experience, and the discipline to execute a traditional fundamental stock picking strategy that works. So we do still believe that works. We believe that there are some great quant firms out there who are competing with Google and Facebook for talent, and that these teams have the information and the data and the resources and the talent to generate alpha even in the most efficient markets like the US. One of my personal favorites is specialists operating in less crowded or less efficient markets. So this could be a strategy this could be a Japan specialist strategy, a European specialist strategy, a China A-share manager, a healthcare fund that has a specific expertise in biotech or something like that. And so that is another place we think it works. We also think, I know activism is kind of a dirty word, but people who can create their own catalyst, create their own value, we believe that they're capable of outperforming as well. So those are just a few examples. So in summary, TRS believes in active management. We just think there are nuances in the active-passive debate that we have to be willing to acknowledge, like active management working better in some places and us having to potentially utilize more factor-based strategies in other places. So thank you very much.
Thanks, Scott. Please welcome to the stage Ann Lester, Head of U.S. Retirement Solutions for Global Asset Management Solutions, J.P. Morgan Asset Management.
I'm sorry. Those are probably the two hardest words in the English language to say. I'm sorry. Really hard to say. If you're an active portfolio manager, or if you are in the business of hiring active portfolio managers to generate results for your clients, you really don't want to have to say those words to your clients. I'm sorry. I'm sorry I underperformed. Sorry I'm overweight emerging markets. I'm sorry I picked somebody who is underperforming. They're really, really hard words to say. And when I think about what we are focused on doing on my team, which is generating outcomes for individual investors who are saving for retirement, we think it's even more important to think about the context that we are saying I am sorry in. Now, every day when I walk to work, I take the train into Manhattan, and I walk to our offices in Midtown from Penn Station, I make a point of looking for the delivery truck of our very first target date client, who is still a client of ours today. They are a very large consumer beverage company. I can always find one of their trucks anywhere in the world. I saw one this morning actually driving to the airport on the turnpike right next to me, an 18-wheeler. And I always think about that truck driver and think to myself, you are my client. That guy, it's almost always a guy, lugging the dolly, that crate of beverages over the curb, right? That is my client. And I was just thinking as I listened to all these explanations and conversations that we were just having today, which I found compelling. It's what I do for a living. Think about this stuff all the time. They would have no idea what we were talking about, and they don't actually care. If you think about your individual client sitting across the table from you, none of them care. My father asks me, what do you think about my portfolio performance? And I say, I don't know. What did you want the guy to do for you? Right? What outcome are you trying to achieve? So this notion that indexing never means having to say you're sorry is, I think, a very scary concept to start embracing, right? And why do we want to embrace it? Because those are such hard words to say. And I think especially when you are thinking about picking individual managers and individual asset classes, and as we've all described in US large cap equities, it's so tempting to default to this myth that means you're never having to say you're sorry. So if you buy an index manager and you're only focusing on the outcome of that asset class in that context, yep, you can say, I know exactly what you're going to get. Assuming the index manager is good, you're going to get the index minus their fee. I won't have to say I'm sorry, I'm safe. But you're not actually tying that to the outcome that your client is asking you to achieve for them. Certainly in the context of an asset allocation fund, and I will acknowledge freely that this is entirely self-serving, but when you look at the 5-year rolling returns of our 2030 fund, for instance, and look at the number of times it is in the top quartile, net of fees 100%. Outcomes are what we care about. Outcomes for a plan sponsor, outcomes for the truck driver, outcomes for your end client at the end of the day when you put all this together. Indexing means never having to say, I'm sorry. What is sorry in this case? Sorry is underperforming a benchmark. Sorry is not getting somebody to a safe and secure retirement. That's how I think about sorry. Now, when we dig under the hood a little bit and try to understand what is going on in the asset allocation world when people are indexing, our contention is that most index providers are optimizing the portfolios that they build around fees and tracking error, i.e. they're putting the most things in their portfolio that are the cheapest to index and the things that have the lowest tracking error when they index them. We did an analysis a couple years ago, and if we tried to replicate our target date glide path with Vanguard's index funds, our fees would be twice as high as Vanguard's, because the things that they don't include in their glide path and the weights that they put them in at skew wildly the cost for the end client. So we ask ourselves, is asset allocating around cost control necessarily going to get you to the right place? Is that going to mean you won't have to say I'm sorry at the end of the day? And I think that's flawed logic. Now, when we look back at what's happened, we find a pretty clear and compelling advantage, right? There's a statistical example, obviously picked carefully. Maybe not. Maybe it would be true for any of these funds. But it's not just true right now. And again, that gap of $10,000 or so that you've got over 12 years, that's nice. When you think about the truck driver and you think about a 45-year career earning $50,000 a year, contributing 8% of that a year after year after year, we'd hope they stayed that steady, we see a small benefit from that superior asset allocation and a very large benefit from the 50 basis points that we've added for active management. Now, $71,000 after a lifetime of saving may not feel like a lot of money to the people in this room, but that $70,000, when you translate that into yearly income for that truck driver, is going to make the difference between them being able to go and see their grandchildren in person or having to Skype with them instead of seeing them in person, right? That difference is enormous. And I think when we lay next to one another, right, the argument that I think a lot of passive providers make, well, you only can count on the fees, therefore, you know, if you can control those, you've done your job, right? You've defined away uncertainty. We think you're missing the point of only thinking about things that you can control on cost. Now, I live in the 401k world. Litigation is an ever-present conversation. And that brings me to my second myth, which we hear a lot. We hear this a lot from our clients. We hear a lot of this from the advisors that work with plan sponsors, and sometimes from the institutional consultants that work with plan sponsors. And this is the myth. If I hire somebody cheap, I won't get sued. And this myth is, I think, particularly dangerous because it goes at the heart of what it means to be a fiduciary. To be a fiduciary is to put the interests of your participants in front of your own. And there have been a series of court rulings that have, I think, rather soundly beaten this myth. And this is in particular from the Ninth Court, is, I think, important. Fiduciaries have the latitude to value investment features other than price, and indeed are required to do so. Now, again, I cannot tell you how many times I have had someone say, we'd like to hire you, but you're more expensive and we'll get sued. This is an absolutely frank conversation that happens. There have been lawsuits against, there's been one lawsuit that I know of against a plan sponsor who documented that they hired an index provider so they wouldn't get sued, and they got sued for that because they were not acting in the participant's best interest. They were looking after their own best interests. So again, all other things being equal, fees are incredibly important. They are not the only thing that is important. Now, I think we've heard a lot about indexing and its flaws, the way we need to think about understanding and analyzing what's going on inside of active management. This is the other myth that we hear a great deal. Well, I just want to buy the market. I want to buy the world. I just want to make sure I get everything that I need to get. And, you know, when we think about what you're buying in the US equity market, and again, I hadn't realized to what extent we were all sadly in agreement with one another, I think, on the panel. When you're buying a US equity fund, you are pretty much getting the US market, right? You know, this is the sort of the biggest index of the US stock market. You're getting 99% of the total market. The S&P gets 86% of the stock market, right? That's pretty good coverage, right? What about fixed income? I don't talk a lot about indexing and fixed income, but a lot of people do it. You're getting 50% of the US fixed income market when you buy the ag. That leaves a lot of stuff out. And the other thing that we find very interesting when you compare what's going on inside of an index, when you're buying an S&P 500 fund, for instance, you've got the equity index. The index, the companies who are growing inside of that index, whose price is improving, become ever larger parts of the index, and you buy more and more of them. And there are moments in time when this is not a great investment strategy, but, you know, generally, you want to buy more of what's doing well, and presumably their stock prices are going up because the company is being well managed and it is making good management decisions. In the fixed income index, the things that become larger and larger in the index are companies and countries and parts of the government bond sector that are issuing more debt. Generally, companies that are issuing more debt are not necessarily the companies that you want to own more and more and more of. So there's an underlying catalyst going on inside these two indices that I think many people don't understand very well. And finally, when we think about what's going on inside of the ag today compared to the pre-financial crisis, you've got a lot more stuff in there that doesn't have much or any yield. You've got almost double the amount of treasuries in the ag. You've got more corporate debt with relatively low spread that does not provide much cushion against a rising interest rate environment. And you've got a lot more duration. Duration's gone up to almost 6 from 4.5 before the financial crisis. There's very little cushion if interest rates start backing up at the sort of middle and long end of the curve. And so I think there's going to be a lot of surprises about what that market is going to do to the individual who owns it. So when I think about what we are trying to do for our clients, generate an outcome that is going to satisfy their needs and wants and desires, in my instance, helping people get safely over the finish line, get to a retirement that they want, I think a lot about not having to say I'm sorry. I think about literally the millions of people that are invested in our target date strategies. I think about that truck driver, and I think about how can I make sure I am not going to generate an outcome that you won't like, that will fail you in your retirement. But to me, we are being lazy investors and poor fiduciaries if we are not asking ourselves, how can we do everything that we can to generate the outcome that we're trying to achieve, thinking holistically about all of these factors, digging under the hood to understand what's going on, when and how, and doing everything we can, including risking saying I'm sorry. And as a last thought, right, and again, we've all been sharing data like this, you know, saying I'm sorry when you buy an index fixed income manager, for instance, over the last 10 years, 97% of the core plus managers in investments outperformed the index. 97%. Now, that's not always going to be true in every 10-year period. It's lower in shorter time periods. But again, when we think about saying I'm sorry, right, I would be apologizing, frankly, if I own the index in that circumstance. So with that, I'd like to say thank you, and I think we're going to get ready to bring the panel up.
Thank you, Ann. I would now like to invite Scott, David, Martin, and Rolf back to have an in-depth discussion.
All right. Well, thanks again to everyone on the panel. I really appreciated the discussion. I mean, I live and breathe this every day and still manage to learn something. And again, appreciate everyone staying around. So I do want to make sure we leave time to get your questions out of the audience. But again, I hope we have enough time here. I did want to, drive out some more of the points in the discussion. I think, one of the first ones, and maybe we'll start with the more academic theoretical issue that was on the table, because I think, anytime someone like Bill Sharp proposes something, I want to give it some merit. He's a Nobel Prize winner. And I think, there's probably some solid thinking behind that. So, like David, let's just assume that's true. I think one of the things it reminds me of is there's that old joke. It's a little bit morbid, did you hear the one about the statistician that drowned in the lake that was on average 12 inches deep? I mean, and I think that's kind of the point here, right? That what Sharp was saying is if you look at investment management on average, yeah, maybe there's this theoretical point that after fees you would underperform, but that doesn't mean that there aren't groups of organization or managers that can outperform, right? And even persistently, right? So if you think about the distribution, that's sort of centralizing a single measure around the active management industry, but it's not suggesting that there aren't firms that can beat the market. I mean, any thoughts about this?
Yeah,
was that kind of what you were driving at?
Yeah, I mean, what I was driving at is really that when we do these studies, and we can do them a couple ways, you can look at the individual portfolios or you can look at all the share classes. Typically, you're looking at all the share classes because the people doing the studies want to show the impact of the fees. Well, there are lots of clients out there that would never consider a C share that had a 2.5% expense ratio, where they could buy the lowest, an RIA could buy the lowest share class that might be 80 basis points or 60 basis points. Again, if you did a minimum amount of due diligence and you've read any of Professor Kramer's work, you'd know not to buy a manager that had 40% active share. If 60% of the portfolio overlaps with the benchmark and you know there is no alpha coming from that 60%, the manager's security selection on the 40% would have to be absolutely astronomically spectacular to outperform the benchmark. What I was getting at is simply if you get rid of these structural laggards, things that really, as I said, my 10-year-old could probably figure out, these things aren't going to outperform. Your chances of picking an active manager are pretty good. And again, I'm not sure that Sharpe's math is wrong. I just think for me it's irrelevant because I don't think that when we look at a universe of 500 large cap blend managers, that a good RIA who's trying to pick a good manager should really be looking at all 500 of them. They probably should be looking at about 25 or 30 of them that really live up to the characteristics that the actual research over the last 20 years has highlighted as being likely to find alpha.
And that's what I'm trying to drive out here. I mean, isn't this really shining a light on the value of manager research, right? That the ability then to try to identify, obviously in advance, who those better managers are, right? That there's a possibility there, but it does raise the discussion to now, can I find those managers in advance? Yeah,
and I think these things are directly related. If you believe Sharpe's work that on average they're going to underperform or be around the benchmark, then the natural byproduct of that is you actually have to believe you can find a good manager. I think most people in our business, Scott obviously does this, we believe that you can do this. I would agree with Sharpe. If you walk into a room completely blind and you know nothing about the underlying managers, but you know net of fees, the average one might underperform, you probably should buy an index. I don't think most smart people are doomed to that bleak an outlook in terms of their manager selection.
And Scott, maybe, I guess, thinking about your decision-making process that you went through, how much of that was driven, I guess you said it was asset class specific, by the fact, there's just a belief that there weren't enough, managers in a given asset class that would outperform? Was it driven more by that belief or the belief that you just couldn't pick them, and vice versa? Are there asset classes where you believe there's that opportunity and you feel you also have the ability to find them?
Yeah, I mean, it's kind of hard to differentiate between those two, right? Because at the end of the day, you just have your results, right? And so there is some combination of, this was, I think we can tease out that it was a worse opportunity set in the U.S. than it was in other markets. But we can't pretend like we didn't, like we went out and we found not the best managers in the U.S. equity space. And so I think it was definitely kind of a combination of those two things. Just kind of empirically, we see this to be the case. We need to do something to kind of change this. And like I said in my presentation, it's not a complete throwing in of the towel of U.S., but I think it's a scaling back to say, where do we really want to spend our time, effort, and resources? Like if my team is going to spend, all of our time sourcing managers, maybe we spend a little less time on the US and we go spend time in emerging markets where there is good inefficiency, less developed active management, and we feel like we have a little better chance of success.
Yeah, that's good. I think another and maybe this is one more for Professor Kramer's. I know that one of our competitors does a fairly well-known study of active management versus indexes, and I'm somewhat surprised sometimes because I've seen cases where they would show that over some 5 or 10 year period, in a particular asset class, that 60 to 70% of the active managers underperform the benchmark. And I thought to myself, that's worse than random, right? That's telling to me that's almost suggesting that active management is perverse. And for me, it's almost a question of, is part of the problem that maybe we're not using the right benchmarks? And I think that obviously I'm a fan of the CPZ paper, yes, as it's been abbreviated, but maybe you could talk about just the problem with benchmarking.
There are a lot of somewhat complicated statistical methodological issues with studies like that. So I know what studies you refer to.
Right.
Here's one issue. Let's start with three. Let's say the whole universe consists of 3 actively managed funds. One fund always outperforms, one fund, and the other 2 funds never outperform. Okay? Then the way the study works is they say over 10 years, 1/3 of funds outperform. Now in reality though, the 2 funds that always underperform, they will drop out of the sample pretty quickly. The study doesn't incorporate that. They simply do not. And so over 10-year periods, the funds that make it for the full 10 years have the same weight as all those funds that drop out halfway. Because on average, less than half the funds that they start out with are going to be there in 10 years. That's what it's called reverse survivorship bias, is that the actual experience of investors is very different than averaging actively managed funds over a longer period of time because the underperforming funds drop out. That's a very simple, I can make several other points related to that, but it's a very simple example is that after a couple of years, the two underperforming funds are simply gone, and everyone has shifted money into the investors, into the fund that's doing well. And so the average experience of investors is much better than 1/3.
Because again, isn't it, Trevor, if you ignore the sort of the survivorship issue that, again, if I'm just randomly picking managers, right, on average, if the zero-sum game is true, I should expect to perform, do better 50% of the time, right? I mean, it's an extreme case.
That's right. But that has all kinds of assumptions that may not hold, right? I think what Sharpe was thinking about is really data. I don't think he was thinking that much about what is actually contained in those portfolios, because at the time when Sharpe was writing his papers, we had very limited data on what active managers were actually are doing. Right. If you actually look under the hood and you look at the holdings of actively managed funds, these portfolios, at least if they have high equity here, look substantially different than the index. And once you see that difference, I think his argument, becomes less compelling.
Right. And I think another element that I wanted to drive out, I think, and coming from your presentation was, I think this notion of active passive and, an active, underperforming is obviously very specific to a specific activity of stock picking. And, so the question is, but is that all it's about? And I think, your point about that, that potentially investors need to realize that, while that's important, that, that the notion of, getting the best performance for some level of risk, that there's a whole broader range of, the outcomes are important. Even something like just, servicing clients or, keeping them calm, there's all those qualitative areas. I just think sometimes there's too much focus on, the very quantitative measure of, what's my excess return. And yet, in theory, what people are getting paid for, it represents a broad range of activities.
Well, you just hit on a point that I get cranky about sometimes, which is, most individuals have a portfolio that's made up of multiple asset classes, and there is no market for that. Like, you can't buy the market, right? Especially if it's a risk-adjusted portfolio. You're buying somebody's efficient frontier, I hope. You're buying somebody's definition of what should be included on that efficient frontier. And right there, you're definitionally in a whole series of active decisions. And I think the value proposition for the advisor is arguably less around the construction of that portfolio, which I think is becoming increasingly a commodity, kind of a controversial thing to say as an active manager, and more around all of that other stuff, right? Which is going to be, can I help my client save more money, save more consistently, really articulate how they feel about present sacrifice for future benefit, right? How much can I save today? How much do I want to spend tomorrow? How can I not buy high and sell low? How can I not fall into behavioral finance traps of fear and greed? How do I stay on course, right? Those things are all things we don't know how to measure. And so we don't talk about them as, I guess, I'm blanking on his name, but Morningstar came up with the Gamma paper, right? And the notion that there's this other value added that through time will show up in the outcome that individual achieves because of this holistic relationship, I think, is one that we would do well to become better at measuring, because as long as what we are defining ourselves by is what was really easy to measure like 50 years ago when we developed all this stuff, I think we're probably in trouble as an industry.
I think that's a good point. I mean, how many financial advisors out there had to coach their clients not to sell in the middle of a financial crisis, right? Like, that's an active decision that somebody who's not financially sophisticated has no clue what to do about. Having
the courage to rebalance, even,
right?
I mean, that's value added, and it gets lost, I think, in this entire dialogue.
Well, I think also your presentation brings up a point that I think I'm very familiar with, which is, potentially the difficulty of constructing a multi-asset benchmark, because, in single asset class space, again, thinking about something like stock picking, it's fairly straightforward how you would do that. You know, the market cap weight, and despite the limitations in the bond side, it's still this convention, right? But then when you start to talk about multi-asset, again, I think, you know, having tried to construct multi-asset benchmarks that are applicable for a broad range of outcomes is problematic. I think it sort of raises this question, like I think that you're getting at, that maybe there should be less focus on trying to beat something and really just trying to achieve a specific outright, being more concerned about the outcome you're achieving, right?
Yeah, and I think people are always wanting to measure, right? You want to get a grade, you want to have a sense for the value of the transaction or the service that your client is paying for. I just, you know, I wish I had a better suggestion to make. Then it's really hard. But you know, I think we all need to figure out how to, you know, I think about the ability to help somebody save more, and if we could get somebody to save, you know, 2% more of their salary every year, they would have a radically different retirement, and that's much more important than the 25 or 50 basis points extra I can get them as investors, right? That 2% higher contribution is going to be a huge lever on their return. The 50 basis points is great, don't get me wrong, I'll always fight for it, but that's not the lever of a successful outcome. And I think we have to be better at managing, measuring, articulating, and defining those for our clients.
I think another area that, you know, Scott, I think your presentation triggered it, is there's this notion, again, there's this misnomer about, you know, what's passive management, because clearly, you know, some of what we're doing now is clearly active, right? A lot of the newer strategies that we're developing are no longer market cap weighted. We have, you know, smart beta, multi-factor. And I think there's this notion that, you know, because they're indexes, that they're, you know, they should be free. And it just, you know, I'm not sure if investors recognize they're, you know, that's more than just a nuance. And the example I use is, you know, if you look at the Russell 2000 index, you know, my promise to you as an index provider is that's going to give you small cap exposure. But I'm not taking a view about the small cap premium, right? As the index provider, I'm not holding that conviction. That conviction now is being placed on the investor. And I'm not sure do investors realize that, you know, by investing, even in a broad market index that might be US equity or small cap equity, that there's an active decision they're making to be, you know, allocated there, potentially overweight or underweight. I mean, do you think, and for anybody, right, do you think that investors recognize that there really is a very active decision even when you're using an index vehicle?
I'm not sure if they do. I mean, on my team, we're certainly conscious of, I think the point that David made, that just by doing active management in the first place, we have a lot more exposure to the small cap premium, like you're saying.
Actually, maybe more specific to you. Do you feel that it's as recognized within your organization that even the practice of getting factor exposure, you know, should be rewarded, right? That you're obviously compensated, that's not trivial, right? That even just getting factor exposure, you know, comes at a cost, and there's activity that you have to do to get there, right?
Yeah. I mean, it's clearly recognized that's a critical value add for us, given, you know, the amount of money that we're putting to work in it. And you know, it's not free money, but it is a little bit, you know, it's a little bit easier and a little cheaper and a little more efficient to access that stuff. And I don't think that's just for an organization like mine that has, you know, the ability to do this stuff internally. I think there are, you know, this is a business opportunity for the JP Morgans and BlackRocks of the world, and they're capitalizing on that opportunity to provide, you know, the everyday investor with cheaper solutions that do more simplistic factor-based investing. So that's, you know, not just available to us.
Yeah. Again, anyone else? Do you feel that investors recognize the active decision they're making when they, you know, invest in a passive vehicle?
Yeah, I mean, I see this all the time, that they, you know, this was, it came up this morning a little bit in Chip Rome's presentation. He clearly threw alternatives under the bus and highlighted the great presentation, but I always want to throw myself out of the building when I see this incredibly misleading comparison of alternative strategies to the S&P 500. Every single category he listed has less than 70% of the risk of the S&P 500. It was back in the 80s when you could have 70% of the risk and beat the bench and beat the S&P 500. Those days are long gone. These decisions have to be made on an asset allocation basis, to your point. If I want, I should be okay making the asset allocation decision that I'm willing to underperform the S&P 500. I don't want pure equity beta, and I should be okay with that if I'm only taking on 50% of the risk. If I get 70% of the return at 50% of the risk, that's alpha. That's an asset allocation decision. And I don't actually care that I didn't beat the S&P 500. The S&P, the problem with clients is, as my old boss used to say, when the market's going up, they all want excess return, their relative return, and when the market goes down, they all want absolute return. They don't want to lose money. And you can't run an active equity portfolio to deliver both simultaneously.
Yeah. So I just have one more question, then we'll open up to the audience, and maybe this, more for Professor Kramers or anyone else. I think, as I mentioned, there's also this related concern about, that there's the more passive investment you have, there's this systemic risk now in the financial system. But I think there's also, there's this potential theoretical argument that, at some point, if there's too much passive investing, all of a sudden we'd start to see more pricing distortions. That in theory, there's a limit to how much of the market can really be passive before active managers step in. And I think relating to this notion that, the U.S. large cap equity space is pretty efficient, but isn't there a chance that, again, that depending on, where the money's going, that could change, right? That this is not a perpetual, a persistent situation, right?
Yes, yeah. We published a paper 2 years ago where we looked at, on the one hand, how active managers reacted if their environment became much more competitive because of a huge inflow in passive products. And our results are really consistent with your story, is that basically Darwinism and competition works. In markets, and including very much US markets, it's become much more competitive for active managers because data has become so cheap. What we find is that as a result, active funds become more active, their active shares go up, their fees go down, and their performance improves. And we studied this in 30 different international mutual fund markets, where the US market is clearly the most efficient, but also the most competitive. Once you go outside the United States, active shares are generally much, much lower, and expenses are generally higher. And so it's particularly when you go outside the United States that you have to be particularly careful what you're buying and how much you're paying for it. But we found this result that competition works, that competition makes active management more compelling. That's the main result of our study.
Okay, great. So like I said, let's go ahead and if people have questions, please raise your hand and we'll have someone with the microphone come over. We have one right here. Sorry, the lights are kind of bright, so I'll have to, might take me a second to see the hands go up.
Son?
Yep.
This is a follow-on to that last question, and since 2009, one of the charts showed it was much more difficult for U.S. large cap to outperform pretty consistently since then. Has there been research work that has looked at the riskiness of the indexes, particularly during this last 8 or 9 years?
That's a great question, and you're right. The last 10 years have been relatively challenging for the more active managers in the United States. Part of this, I think, is because small number of names, the largest stocks, have driven the market. If the largest stocks drive the market, almost by construction, it's very challenging for active managers. That's an explanation, perhaps not an excuse, right? But almost by construction, active managers are more likely to have smaller names, more value, less liquidity. The last 10 years were markets where the mega caps, the growth, and the liquid assets have outperformed. That will not persist for that long. I think it's remarkable how long that has persisted. And I think the market has already been changing, and I think the last couple of years have been better for active management. It's very hard to predict this, of course, but my intuition is that that cannot last that long, and when that changes, that's going to, again, active management will have a much better chance to outperform. Yeah, exactly. Well, in my view, if the index performance is driven by a small number of names, that's potentially much more risky, right? The FANG stocks, that's really been driving the index for the last couple of years. If Amazon and Facebook, et cetera, and Apple, if they underperform, then as an index investor, you're very, very heavily exposed to a small number of names.
So I wrote about this in a research note last month talking about index concentration. And if you look at the last 4 years, the S&P 500 has become about, depending upon which measure you use, about 25% more top heavy in terms of the highest names and some other metrics we look at. It's actually less concentrated than it was in 1999, but that misses a subtle point about technology overweight. Basically, the index is less concentrated than it was in 1999, but it has the same tech concentration as it had in 1999. The argument that you often hear from some index people is that, well, when we get a big sell-off, it won't really matter that all this money poured into indexes because all the money that's in the indexes would have been in the active managers. And my answer is, well, that's sort of true, but not quite true for the reasons we were just talking about. Yes, all the names would have been in an active portfolio, but not at the same weights. They would be in the index at bigger weights, which my answer to this, to directly to your question is, I believe the indexes have become slightly more risky. I don't think it will matter for the average investor. If the stock market falls 40%, but it actually falls 42% because of more money's poured into indexing, your client's going to be pretty aggravated that they're down 42%. They're not going to care that they only would have been down 40% if all this money didn't flow into passive. I think theoretically it's a good argument. I don't think it's going to matter retrospectively.
Okay. Yeah. Yes. Have there ever been, and I know there are a lot of Delbar studies on investor behavior, but to your knowledge, is there any, have there ever been any on investor behavior using strictly passive indexes, especially during times of market turmoil?
I can't speak to the studies, but I have a guess about human nature. When the market falls a lot, if you have good client service, if you're an active manager, you usually have a pretty good explanation for why what you owned is down. The passive manager has no explanation. I owned it because it was in the benchmark. My theory, or at least my thought, is you would hope that the average investor would stick with an active manager longer and not sell during the down market if they had good client service and ex-ante reason to believe that performance would rebound. None of those things exist in a passive strategy because the stock wasn't bought for a particular reason. It was bought because it was in the index at that weight.
Yeah, and I actually have done some research on that. That's what we found, is that the higher active share funds, their investors seem to be more forgiving when they underperform, at least for a while, and they see larger inflows if they outperform.
Sorry, is there another? Any more questions?
Any other questions?
One more.
Yeah, I think we have one over here.
Go ahead, just talk loud.
Yeah, go ahead. I'll
speak loud.
Okay.
First, thank you very much.
Thanks, Paul. Professor Kramer, your work on active share has been seminal, revolutionary, and it's had great impact through the industry, and it's had enough time now to be digested by not only manager selectors, but also by the marketing departments of active managers. And I can observe that there, for managers who have low active share or active share lower than that of their competitors, they are pressured by their marketing colleagues and by their management to get their active share up. And one could speculate that the pressure is greatest on active managers with low active share who also lack skill because they're under the most commercial pressure. So I wonder if in fact, active share as an indicator of the incidence of skill, obviously not a cause, but as a suggested indicator, is losing its power.
Thank you. The last 10 years have been challenging for active managers, and so the evidence that high active share managers have outperformed in the last 10 years is not very compelling. At the same time, the underperformance of low active share funds that are expensive has been very, very persistent over, I'm very confident that if you're a low active share fund and you're expensive, that it's very likely going to underperform. High active share is not a measure of skill. All I need to do to have a high active share is just buy a bunch of different securities that are in my benchmark. It measures the extent to which whatever skill you have is applied to the fund, not the skill with which you do that. At the same time, I do think that running a high active share portfolio over a long time is difficult. So if you have a very good track record with a high active share, I would say that's less likely to be due to luck. But you also need to do something that is simply difficult to do. Because if you do something that is easy for others to do as well, and if you're successful, a lot of money will flow into other funds, and then whatever you're doing will be competed away. So I wrote a paper titled Active Share and the 3 Pillars of Active Management, where I tried to make this point. Right? High active share, yes, but you also need skill, you need conviction, and you need opportunity. Okay.
Thank you for an excellent presentation. That was really insightful and provocative. Please join me in thanking Rolf, Martin, Dave, Scott, and Ann for their excellent presentations.